Hi, my name is Brian Tully, Managing Director at Total Bank Solutions. Today, I'm excited to be here with Mike Musial, who is Head of Sales for Securities-Based Lending here at TBS. Mike, why don't you provide us with a little bit of background about your experience in the SBL industry?
Thanks, Brian. Happy to. I was actually on the first securities-based lending team at Merrill Lynch when they rolled a product out to the market. Subsequently, I've rolled out securities-based lending to Morgan Stanley, UBS, and Raymond James. So I have a really long history of analyzing the asset class, building business plans, and tracking the penetration and revenue that comes along with it.
That's great. So, Mike, one unique aspect of SBL is they react differently to interest rate movements versus the traditional lending options. Why is that?
They're just a different animal and they serve different purposes. So, a good example would be think about real estate lending. There might be a time when there aren't a lot of buyers in the real estate market and it's hard to sell a home, but those people very well may be doing home improvements and drawing on lines of credit. So, they react to different stimulus within the market. It's pretty wise to have a balance sheet that has some of everything in it. So depending on what the markets are doing, you're always covered. And I think the ease with which securities-based lending can both be originated, underwritten, and monitored makes it an ideal candidate to complement some of the fixed instrument structures that you see within a lot of banks today.
So, what I'm hearing is partly when you're looking at these loans from a bank's perspective is the bank could be looking at risk-adjusted returns. Am I hearing that right? And why is that important in loan portfolio management?
No, I think you're hearing it exactly right, Brian. Looking at just raw rate of return on an asset class can be a little bit short-sighted. A great example might be commercial lending. The rate you can charge is very high relative to what you could get in a securities-based loan, but the rate of default is also extremely high compared to securities-based lending. And the amount of money and cost associated with underwriting and maintaining the integrity of those books is much higher than you would get with a securities-based lending book. So if you're looking at what is the risk-adjusted return on my capital, securities-based lending actually becomes a very attractive asset class, particularly in a low interest rate environment.
Right, that makes a lot of sense, Mike. So in your role at TBS, I assume you talk to a lot of bankers. So in 2021, what balance sheet challenges are motivating bankers to adopt an asset class like SBL, Mike?
Yeah, there's a couple confluent effects in the market right now that are really making them look to alternative asset classes. They're awash in liquidity, so they have a lot of money that they want to lend. The traditional avenues for that lending, real estate and commercial lending, are one under a lot of pressure given the response to the pandemic and the likelihood that there's going to be vacancies and defaults and things like that. And the third leg of that stool is we're at near or at the very bottom of an interest rate cycle, historical lows on interest rates, and they're very reluctant to put a lot of money to work at historically low rates, knowing we're in an inflationary period that's very likely coming around the corner. So having an asset class that can actually float with the rising interest rates and very short-term tenor gives them the flexibility to complement the more fixed assets in their balance sheet.
Well, what you're saying makes a lot of sense here, Mike, and really appreciate your insights. And if any of you would like to learn more about securities-based lending, please visit our website at www.totalbanksolutions.com.